Hello and welcome to video 6 of the Licensing Education Series by AIC, a partner of American Senior Benefits. Please watch each video all the way through once without taking notes and then go back and take notes. You'll find that you retain more information that way. If there are any topics that you'd like me to do a deeper dive into, please comment to tell me the specific information you want me to go over. Thanks for attending and let's get started. So today I'm going to go over some of the less common types of life insurance. These usually have a limited or niche market. The first is industrial. Industrial insurance. In Oklahoma, these policies have a maximum of $1,000 face value, and the premiums are paid either monthly or more often, but less often than weekly. So the premiums have to be paid somewhere between weekly and monthly. So it could be every 2 weeks, for example. The policy must also have industrial policy printed right on the face of it. These are an old style type of policy that was designed so that industrial workers or low income earners, back before there were worker benefits or protections, could get buried. The premiums are collected by the agent each time. Now, I've never seen one of these, but according to an article from back in 1990, even though most companies stopped selling these back in the 1960s, there were still about $25 billion worth of this type of policy on the books. Now, this is 30 years later. That's the last article I could find on it. So I don't know whether any of these still exist or not, but it does pop up from time to time on the test. A variation on industrial insurance is home service life insurance. These are usually between $10,000 and $15,000 in face value, and they're usually paid by auto draft or by mail, but there are still a few debit route agents who go around each time to collect a premium. Another type of niche insurance is credit life. Credit life is usually a decreasing term policy that's used to pay off a debt. However, the creditor is the beneficiary, hence credit life. The next one is joint life. Joint life is one policy written on two people, usually spouses. Joint life pays the living spouse upon the death of the other spouse. A variation on joint life is joint survivor. This again is one written on two people, but this kind pays out on the death of the second person. Why? Usually for estate planning or funding for a dependent, like a child or a disabled dependent of some kind. The next kind is juvenile life. You might hear it referred to as a jumpin' juvie. These policies start with a low face value when the person is a minor and then jumps up to a higher face value at a certain age, like 21. They usually take over the payment for it as well at that point. The next one are modified premium and graded premium plans. I mention these because there are also modified and graded insurance. We went over those a couple videos ago. Remember that if it asks about modified premium or graded premium, it's the premium that changes over time. If they ask about modified or graded insurance, it's the death benefit that changes over time. Another type of unusual policy are endowments. Remember, endowing is paying out the policy when the face value equals the death benefit. So endowment policies are policies that are designed to pay out that face value while the insured is still alive. They aren't very common these days, but in the past they were used to fund retirement by endowing at 65 or paying for college by endowing at 18. They are inflexible, and the tax consequences have changed, which has made them pretty unpopular. The last one I'm going to talk about is pre-need funeral insurance. You'll run into these in the field. You might even have agents around you who have dealt in the funeral business, and they talk about pre-need funeral insurance. So you'll run into clients who've already paid the funeral home for their funeral and cemetery services. That's actually a type of increasing life insurance policy that the funeral home sold them and then named themselves as the beneficiary. So they get the death benefit and the commission for having sold it. So pre-need plans. A kind that isn't uncommon to own but is a little more uncommon to sell is group life. If you're going to be selling group life, there's a few things to know about. First, individuals don't have an insurance policy. The group has what's called a master policy, and each insured then gets a certificate. The underwriting is done on the group as a whole, not on each individual. As with life insurance, individual life insurance, the benefits are not taxable if the beneficiary takes it as a lump sum. With these policies, the employer may pay all the premiums, which is called a non-contributory plan. So that's the employer paying all of it. And in that situation, all of the employees must be covered. If the employee pays some of the premiums, which is called a contributory, also known as a participating plan, then at least 75% of the employees must be covered. If the employer pays the premiums for the first $50,000 of coverage are not counted as income, and the employer can count the premiums as a business expense, so they can deduct them from their taxes. That's why you usually see with group life insurance, that's about the maximum they ever provide is $50,000 in coverage. If a group wants to get group life, the group can't have been formed just to get group life insurance. So you can't get together with a whole bunch of people to get life insurance so that people who are a little less unhealthy could get it, because it's group underwriting, not individual. The group has to have been formed for some other reason, like a fraternity or something like that. Group life also has what's called a conversion privilege. Now, in the term life, remember I talked about convertible term, that's different. Conversion, it means that you can turn the group policy into an individual policy when they're terminated or lose coverage because of the ineligibility of the plan or the plan's canceled. The conversion can be for any type of insurance except for term, and it has to be in the same face amount. So if they have $50,000 of life insurance at work, they can convert it to $50,000 of individual whole life, individual universal life, adjustable life, just not term life. Another thing that you might run into is a viatical settlement or a life settlement. This isn't a type of insurance. This is something an insured might do with their life insurance. Basically, the policy benefit is sold to a third party for a reduced amount of cash now. In the old days, before there were living benefits included with most insurance, these were more common. These days you don't see it as much, but If you had a, say, $100,000 policy and you were terminally ill and you wanted to access the cash now, you could sell it to a viatical company. They would then get the $100,000 death benefit, and they would give you a greatly reduced amount right now for it. So that's some of the more unusual types of life insurance. There are a few others out there, and if you run into one in your studies and want me to explain it, let me know in the comments, and I'll make another quick video about it. The next video is going to start in on annuities. Please like and subscribe so you'll get notified when new educational videos are released, and thanks for watching.